How have you been?
Yeah, thanks for having me. I've been good. Yeah, just been hustling away at this SPV raise, and been pretty busy with getting deals done and things like that. But yeah, it's going well.
So let's jump into the SPV raise. So I think, when I first heard about the raise, my first question was, okay, that's interesting. Like, why actually do this to begin with? Like, why would an investor not just invest in on folio stock, right? Like, tell us a little bit about why you're bringing these SPVs to life and what the advantage is for both investors and then for you as a company as well.
Yeah, yeah, because there's really two different motivations there. Like, why are we doing it, and why would investors choose one vehicle versus the other, or both, if you want to maximize the returns. Um, yeah, so for us, it's just a way to get access to more capital without issuing more equity. And small publicly traded companies like ours, a lot of them need more capital. Either they didn't raise enough at the IPO, or they just, I mean, a lot of them, frankly, don't really even have a viable business model. And so the normal option for a company like that is to raise some debt or to do an equity issuance. And we spent a year or two, probably a year, looking at all the debt options out there. And it's actually tricky. It's not as simple as people think, like, oh, you just go out and get some debt. It look You have to look at things like your revenue, your market cap. There are some companies who would lend to us, but because our market cap's quite low, they can only lend like 100K. Um, and then there's expensive debt, there's toxic debt. So what most companies end up doing is not taking debt; they'll just do an equity issuance, and you'll see what's known as the death spiral, where the only people who are going to buy their equity are people who want a ton of warrants. They want like maybe a 20% discount on the stock. And you just see they issue equity, their stock price goes down. They issue equity, their stock price goes down. Maybe they do a reverse split, and then it just keeps going down. And eventually that company goes bankrupt. And so we've always been very wary of doing any additional equity beyond what we did at the IPO. And why we need more money is we have a profitable portfolio of businesses that we've acquired, but we also have some high fixed costs of being a public company, such as directors' fees, insurance, compliance, audit fees, Nasdaq listing fees, pretty much that. But it adds up. So, for example, our directors and officers' insurance is like 200 grand a year. So there's all these things that basically mean even though the underlying portfolio is profitable, it's not profitable enough currently to offset the overheads. And so we've just said, okay, but we're buying businesses. Every time we buy a business, our profit improves. It just goes straight to the bottom line. How can we get more capital to buy more, and kind of escape that thing? Because each time we buy a business, those fixed costs, like our insurance doesn't go up, our Nasdaq fee doesn't go up. So eventually we'll pass that. And so it's been a little bit of a journey over the last 18 months figuring out which is the best way to do it in a way that is still good for the company and the existing shareholders. And last year, towards the end of the year, we raised some money from preferred shares, which is it's essentially equity, but it's structured more like a bond or like debt. Um, but people were a little bit wary of the preferred shares because of those high fixed costs. So they might think, you say you're going to, sell preferred shares and use the money to buy businesses and become profitable, but why are you not profitable already? It's kind of hard to see under the hood and see that, okay, the portfolio is profitable. Or people believe it, but they're still like, yeah, but maybe we're going to wait until you're profitable already before we trust you with buying preferred shares. But at the same time, I was having conversations with people who said the preferred shares are nice, but you only pay 12% on them, and there's no upside. Can't we like co-invest with you So if you're going to buy a business, we can co-invest with you, and then you don't have any debt, and we can get more upside, and we don't get exposed to your overheads. We're just exposed to the underlying business. And at first, I wasn't that sure whether we wanted to do that. But what's changed over the last probably 8 months is there's a lot of businesses for sale now that are cheaper than they were when we first went public.
Right.
Not necessarily because the business is inherently worse, but because capital is more expensive and there's fewer buyers.
And just the market in general. I mean, we're seeing that as well, just in the, the micro media space. Newsletters are cheaper than ever right now, and so you guys are seeing that in the agency side of things with all the agency businesses.
Yeah. Pretty much with everything, but agencies, there's just a lot of them. And so the other thing is expectations about cash up front have reduced as well. So when we were thinking about doing an SPV before, essentially for us, we want to get as much ownership of the business that we buy as possible, because otherwise the amount of money we need to raise is crazy. So for example, if we did like a 2 and 20 fund, we might raise $10 million, buy a few businesses, and it only adds like 100K or 200K profit to Onfolio. So it's like, okay, that's a lot of work to raise that much money for a small reward. So then we thought, well, what if we do like a 50-50 split with investors, where investors pay for the businesses we're buying and we own 50%, they own 50%, then we'll get significantly more profit, and it's worth it. But then the issue there is, sorry, what were you going to say?
Is that the split? Is that the split that you've set up, 50-50?
No. So I'm just kind of going through the evolution now. But the split's much more in favor of investors now, but it still works for us as well. So when we were doing the 50-50 split, we thought, okay, great, that's good for us. We don't need to raise as much money and we'll reach profitability. But when we kind of looked at the spreadsheets and like, well, how much are investors going to earn with this setup? We thought they might only earn 14% or 13% before we start growing the businesses. And so if we don't grow them, that return is maybe not as attractive. Like, we can give them preferred shares for 12% where there's no downside. Or we can give them upside, but they might only get 13%. It doesn't seem that attractive. But what changed was towards the end of last year, I started speaking to a few founders, and I said, well, what if we gave you, so now this is someone who wants to sell their business, and we say, what if we give you some preferred shares and a seller note, and then we just pay 30% cash up front or 40% cash up front? And a lot of people started saying, yeah, that would work for me, because founders just, their expectations are significantly lower now. Yeah. I don't want to say they're more down to earth or realistic, because I think founders, they always want to sell their business for the most they can. I just think, their expectations are lower. And so when I looked at that model, I thought, well, let's say we've got a business where it's for sale for $3 million. So it's making $1 million profit, free cash flow, and it's for sale for, say, $3 million. And the founder will take $1 million cash and $1 million of our preferred shares, and then the third $1 million as a seller note. We could take care of the seller note and the preferred shares. So that's like our give. And maybe we put in a bit of cash for the cash up front, or maybe we don't, because we don't really have much cash. So the SPV can put in $1 million, and then now we've got, say, 66% ownership of the business, and the SPV's got 33% because they've put in 33%. So it's not like the original model was maybe the SPV puts in 100% of the cash and we split it 50-50. Now their equity is exactly tied to what they put in. So if they put in 30% of the cash, they get 30% of the business. If they put in 20% of the cash, they get 20% of the business. And that's great for us because we get big ownership in the business without having to put in a lot of cash up front. But it's also great for investors because now when you model it out, if they're buying a business at 3x multiple, um, that's like a 30% return or a 25% return if the business dips slightly or we pay 4x or something. And so suddenly we said, well, hold on a minute, this ticks all the boxes for us. We don't need to raise as much to reach profitability. And investors who invest with us can get significantly more return. And so, some investors might say, yeah, but we're putting all the cash in and you're not putting any in. But our skin in the game is the preferred shares, the seller note, the fact we're going to be operating the businesses, and we're giving people a pretty good reward for it, which is the like 25-30% ROI. So it's fair. And it's basically like the search fund model where somebody's like, okay, I'm going to buy this business. Maybe they use an SBA loan, and they're like, okay, the SBA loan will cover 80%, but I'm going to bring in outside investors to put in the 20% cash, and then they'll get 20% ownership and I'll get 80% ownership without putting any cash in. So it's basically borrowing from the searcher model, which is a pretty popular model and works well for GPs and LPs, basically.
So you're in that model, you're basically looking for the co-investors to cover the cash portion of the three-part acquisition. So the three parts are so take a step back. You're looking to buy for about 3x net income multiple on these businesses, correct?
Yeah, it might fluctuate to 3.5, but yeah, around there.
Okay, and by the way, that's down from what it used to be a couple of years ago in your experience.
It used to be. I mean, there are still businesses going for more money than that, but it's the markets. It used to be like everything was 4 or 4.5, regardless of whether it was an amazing business, and you might have to pay 80 to 100% cash up front. Whereas now, only the very best businesses are getting that.
Yeah, we're seeing, in the micromedia space, like a lot of just 50% upfront, is becoming like accepted by sellers who are increasingly kind of desperate to sell some of them. But back to your example. So 3x is what you aim for. Now, let's say in your example, in this great email you sent out recently, by the way, explaining how this worked. So you've got $1 million in cash, straight up, goes to the seller. You've got $1 million in on folio preferred shares, and that pays 12% per year, right?
Mm-hmm. Yeah.
And then you've got $1 million note where you pay about 6% interest for 2 to 3 years, and then the principal kind of at various points. I think that's the part that's a little. I'm not dialed in myself exactly on how that works just yet, but the point is that you're starting to do this. The sellers are accepting it, and it's allowing you to make these really terrific acquisitions with a third of the cash that you would normally need up front.
Yeah, exactly. And not every acquisition we do is going to fit perfectly into that model. Like maybe some of them, they want 40% cash up front. Maybe some of them they want 7% interest rate instead of 6% on the note. Maybe it's a 3.5x multiple instead of a 3, but this is the mold that we're trying to fit them into, and then tweaking as necessary.
So for Onfolio, it's clear how it's a great deal. I mean, as you're buying these businesses for much less cash up front at a time when it's just such a ripe time for buying businesses. For the investors, this is beneficial because the investors are making passive investment that's trying to do the math here. I mean, it would be about a 33% annualized return.
Yeah, assuming the business maintains the level that it is before the acquisition, which is that's a whole other part of the equation. But yeah, it would be about 33% gross return.
Yep. Okay, cool. And I think you've been getting some questions as to, how do the Onfolio preferred shares play into things when you're introducing this new financing vehicle. um, there was some concern from the Onfolio community about like kind of like why you were switching from promoting preferred shares, now switch to this SPV model. And again, I need to refer to this great email you sent where you were very honest and open and said, yeah, look, this is the questions we've been getting, and here's the answer. And I just think that's so refreshing to see and to read as a Onfolio shareholder and someone who just follows you in general. You said you tested both offers, and the preferred shares used to be a cheaper source of capital, but some people were put off by the fact that Onfolio as a company still hadn't reached profitability, and so they were worried about being exposed to the overhead. And this SPV model takes that out of the equation. Do I have that right?
Mm-hmm. Yeah, I mean, there's a whole thing with preferred shares where people don't really get them. Most preferred shares convert to common, and ours don't. Actually, I wouldn't say most do, but most people think preferred shares convert to common, and ours don't. So when we were selling the preferred shares, there's kind of two two types of investors who would look at the opportunity. There's investors who understand Onfolio, maybe they know me personally, maybe they own an online business, so they don't have any questions about how do you guys make money. They're like, right, you guys go out and buy online businesses. We understand how you make money. We understand how online businesses make money. We understand Onfolio's model, and maybe preferred shares isn't their, kind of pun intended, it's not their preferred investment vehicle. And they're like looking at preferred shares and they're like, they only pay 12%. And I have concerns about, Onfolio is not profitable. Does that mean your business, you're not good at what you do? All of these things. So it's a little bit of a question mark for them. Whereas if I say, well, do you want to just co-invest in our deals? They're like, oh yeah, I understand that. That's like easy.
Yeah.
Whereas the other type of investor is an investor who actually does understand preferred shares, which is normally an income investor, maybe somebody a bit older, not always, but like, if we're trying to do a stereotype. And maybe they're investing out of their IRA or their 401k or something. They don't really understand what we're doing or what the business is doing. So they'll be like, oh, you're selling preferred shares. And our preferred shares are pegged to $25. That's just what they've always been. It has no correlation to the common share. But they'll look at the common share and they'll be like, wait, what? The common share is 60 cents. Why are you selling me preferred at 25? Like, are you trying to scam me? And it's like, no, it's just a totally different class of share. Preferred shares, something like 90% of preferred shares on the market are pegged to 25. And people might think, well, hold on, is the preferred share going to tank after you list it on the exchange? And then you try and explain to them, well, the preferred share pays 12%. How that's structured is the share is $25. So it pays $3 per year in dividends. It's not a percentage, it pays $3 per year. So if the share suddenly becomes worth $15, that means you can buy it for $15 and it pays $3 per share. So that's like a 33% dividend. So do you think the share is going to stay at $15 for very long? No, it's going to go back up because everyone's going to buy it. But you try explaining this to people and people just can't wrap their head around it. There's a little bit of like, I don't know if what you're saying is accurate. And so you're like, you know what, let's just sell. Let's just have people co-invest with us instead. The types of people who already understand our business model and already understand how the returns work. This is the type of vehicle they want to invest in. So we're just like, let's just do that. Let's just make it easier. It works well for us, works well for them. Let's not overcomplicate it. So yeah, that's why we changed, basically.
It's a great explanation. Look, one question I have is just, and this is going to be a tough question to ask as a Onfolio shareholder, but why isn't the market valuing Onfolio stock where I think it should be? I mean, you look at like your revenue Zen acquisitions. You closed that in December last year, right?
Yeah, December 31st. So
Okay.
basically January. Yeah.
So that business is worth about $3 million. That's a $3 million business, and it's stable. Revenue is up, net income is up. That business alone that you've acquired, like not in cash, but what difference does it make? You've acquired that business through that model, through the cash 30%, 33% cash, 33% note, 33% preferred shares. You're able to acquire that business. That business is worth $3 million. On Folio's stock, where it's at today, what's the market cap of Onfolio? What is the market valuing Onfolio at?
Well, the stock went nuts last night, so it's gone up a bit. It's probably around 3 million, maybe. On Nasdaq, I've just updated their website.
Okay, so I
3
gotta
million,
check
yeah,
the new
yeah,
price. The point is, it's about the same as this one company in your
yeah,
portfolio. I mean, what am I missing here,
yeah, and
right?
that's
Like,
just one of the companies.
yeah,
Yeah, it's people who see that mispricing are like, I'm going to buy Onfolio shares. People who don't buy the shares, they either don't get that or they think, well, there's a few things happening, and I don't know what is good practice for me and what isn't good practice for me with speculating. But my guess would be because we're losing money and we don't have a ton of cash, people assume that we're either going to run out of money and go bankrupt. And that is kind of flawed thinking because it's like, yeah, but we have a profitable portfolio. So, worst case scenario there, we go bankrupt, we sell off all the assets. That's still going to be worth more than the current market cap. So it's sure maybe you can't sell them all for fair value. You have to sell them. There's a liquidation.
right.
Maybe we sell them for 50% off, but that's still the portfolio is still worth more than the market cap, even like in that scenario.
I mean, 50% is on. That's an extreme scenario, anyways, right? Like,
Yeah, I'm trying to be
yeah,
like, listen, even if the very worst case scenario happened, it's still you're still common shareholders are still going to get more, and then there's the preferred share as well. But the preferred shares, even if you think, okay, we pay back all the preferred shareholders because they only get paid back what they've invested. They don't have any claim on the rest of the assets. So if somebody bought one preferred share for $25 and the company has $50, for example, then they get paid 25 and the other 25 goes to all the common shareholders. So it's like even if all of the assets were liquidated, the preferred shareholders were paid back the sort of 2 million that there is in preferred. There would still be like more than 60 cents per share um, given out to common shareholders. So
I mean,
that's not really a thing. Um,
have you had like have you had trouble telling this story to the market, or like it seems so obvious to me? It's like, okay, you have a portfolio of assets. Those assets have a value, even in a worst case, and they're growing. Even in a worst case scenario, like we're still in good shape. It just boggles the mind. I don't know. It's
yeah, the thing is, like I don't think that's the only thing that's going on. So I think a lot of microcap companies, they inevitably, a lot of them actually don't really have revenues, or they don't, they're in far worse shape than we're in. So they end up doing an equity issuance. Maybe they sell, they raise $1 million or $2 million, but shareholders get completely diluted, and they're pivoting around, searching for a way out. Shareholders get diluted. They go below $1. They do a reverse split. So a lot of people just kind of blanket short all of these companies because it's all the same. Like I've looked at a lot of other companies with a similar market cap to us, and I've seen how the stock trades. I've seen how the company reacts, and sooner or later they do a reverse split. They announce they're going to be delisted, or they do delist, and so I think a lot of people don't really necessarily look under the hood with Onfolio. They just go, oh, here's another one. Okay, they're losing money. They're below $1. We know what to do here.
right,
Um,
right.
There's also a lot of investment banks do a lot of shady stuff. Like they'll short a company and then they'll call the company and be like, "Hey, we can raise you some money. You can do an equity issuance or something." And then like the day that those companies sign the agreement, the stock just starts getting tanked heavily, getting shorted heavily. And we haven't signed any agreements, but I think so there's a little bit of a wait and see thing. I think people are kind of like, well, if Onfolio can't execute and can't pull off the SPV, then maybe they can't keep the lights on. So we'll just wait and see. And the day that we go, hey, we're profitable now, then maybe the stock will move quite
And
slowly.
everything changes, right? Yeah, it's
And it's ironic because most Nasdaq companies are not profitable, but they have like billions in revenue
they're on
and
a
tons
different
of
level.
cash.
Yeah.
So it's a different
Well,
different
I agree
thing.
with you that most people don't do the homework and don't do the hard work of actually analyzing microcap companies. But at the risk of putting a friend Tom here in the spotlight, Tom, who's on the call, is someone who absolutely loves microcap investing, loves I don't know if you want to call them penny stocks, yeah, Tom, I don't know if you can hear us if you're on the line, man, but would love to see if you have any questions for Dom here. As I put him on the spot. He might be listen only.
Yeah. Is there a chat? Like,
This is my first time actually using this. Oh, yeah. So he has a question. His
oh,
question
yeah.
he's a big OTC fan, like we talked about. Share buybacks. How does that fit into things?
Yeah, so he's said, is a share buyback an option? I think everything is an option. I think for us, it's a kind of a cost of capital decision. So if we, at the moment, it doesn't make sense for us to do a share buyback because that same capital should go towards reaching profitability. And then when we're profitable, we might look around and say, okay, the market's still not valuing us. We can put some capital on an acquisition, or we can put some capital on a share buyback. You have to kind of look at the
Opportunity cost.
you kind of weigh it up and think what's going to produce the highest ROI. Share buybacks don't always work. Sometimes you don't even have to make the share buyback. You just say you're going to do one and the stock goes crazy. Sometimes you do a share buyback and it doesn't make any difference. And now there's even fewer, you're even more thinly traded, which makes you even more exploitable. So
isn't it kind of admitting to the market, like we have nothing better to do with our cash, right? Like in a way.
Sure. I mean, there's four main uses of capital, right? One is organic growth, so putting the money back into your business to grow. One is acquisitions, which is actually our main business model, so it's not super applicable there. And then two are returning capital to investors. And one of the returning capital to investors methods is just doing a dividend, which is really saying we don't have anything better to do with the capital. And one is a share buyback. You can also pay off debt as well. That's another way of returning capital. And it's not that you're necessarily saying we don't know what else to do with the money. In some situations, you might be saying this is the best thing we can do with the money because, we think we're worth $100 million and the market's trading us at 10. Then
Right.
then the ROI when you pencil it in, it's like that ROI is going to be better than going out and buying another business anyway. But I think it's also like it's a signaling thing as well. It's a vote of confidence. If you're thinking if you're going out and saying we're massively undervalued, the market doesn't value us. You're putting your money where your mouth is and saying, we think this stock is so cheap, we're backing up the truck. And to be honest, I've been in blackout periods for most of the time that we've been public. So a blackout period, there's kind of two or three things that cause a blackout period. One is when the quarter ends, between the end of a quarter and you releasing, let's say your 10Q or your 10K, you can't trade. So like right now, I'm in a blackout period until May 15th when our 10Q comes out. Um, or if you're in possession of some insider information, like there's an acquisition coming up or something like that. And for a company that makes acquisitions, like pretty much we've had a letter of intent out like since we went public. So there was a very, very short window where I was able to buy stock last year, which was May. It was about a year ago, May. I think around May 10th or something, and I bought warrants because they got higher upside. But yeah, I bought something like 500,000 warrants, and then the rest of the time I haven't even been able to. So it's a little frustrating. That's why people set up the 10B51 plans, which is like you're saying in advance, I'm going to buy stock, and then someone else does the trading for you. But going into the weeds a bit here.
What does the overhead really look like for a company like yours in terms of the paperwork and the compliance and the D&O insurance and everything, like per year? What are you guys spending? What does it cost?
DNO gets cheaper every year as the kind of statute of limitations and stuff kicks in. Last year we paid I think 270K a year, and this year we've paid I think it's 210, and probably next year it will go down significantly because the third year since your IPO is a lot of the risk has gone. So maybe it will be like 150 or something. And then audits vary widely, but a quarterly audit might cost like 30 to 40K, and an annual audit might cost around 100. So it could be 80, could be 120. And that's cheap. Like, obviously bigger companies, the audits cost way more. And then you have legal bills, which is things like your securities lawyer drafting various things, consulting with you on stuff like that. And then we also have a third party professional team we work with who they're kind of like the bridge between us and the auditor. So we close our books, we do it in GAAP, and then we send it to this other company who they used to be controllers in NASDAQ companies. They understand how auditors communicate. They'll do things like look at, draft the footnotes, and understand about valuation and stuff like that. So that I think they're probably 20K a quarter. That's the biggest chunk of it. NASDAQ costs 70 grand a year, so that's not, it's not nothing, but it's actually less than 10K a month when you annualize it. And then we have our head office fees as well, but we're not actually, there's not that many of us that, there's like 4 of us, like me, the COO, the CFO, and then 1 or 2 executives. And our salaries are actually pretty, I think most of us earn the same as like most public companies, like one person earns, the combination of all of us. And so, yeah, there were more fees in the past as well. Like we had an IR firm in the past that cost about 10K a month. We've had other things where we'll do an interview with Benzinga, or we'll fly to New York and do some conferences and stuff. But I found the best form of IR is not wasting money on IR firms. The best form of IR is getting to profitability. So I cut out a lot of those expenses.
Cool. Awesome. Yeah, there's so many other questions I have. But I want to make sure we're mindful of time here. So I think we're pretty good. It sounds like you guys are using this as a unique kind of structure that gives investors a good return, doesn't expose them to the parent company's P&L, right? Lets them diversify across multiple acquisitions, gives them upside, gives them capital gains, gives them liquidity. You have an annual exit option, right? Which we
I guess we didn't really talk about that. There's liquidity in 2 ways. One is we'll do quarterly payouts because we want to dividend the profits of the acquired businesses to ourselves, like the parent company. And so we'll also dividend out to shareholders. So that's one, and then the other is I kind of got this from Warren Buffett before he was in Berkshire Hathaway, but people are saying, when are you going to sell these businesses? What's the holding period? And for us, ideally, we want to hold the businesses forever. In reality, maybe we'll sell some, but we know investors don't necessarily have that same time horizon or faith, or maybe they just need the money. So at the end of every year, we'll just say to investors, this is the current value of your holding. Do you want to sell all of it and exit? Do you want to sell some of it? Or do you want to, stay in for the next year? So it's like once a year, they have the opportunity to exit. Give us a couple of months notice so that we can make sure we can buy you out, or if another investor wants to buy in, that they can buy you out. But the idea is people can have that opportunity to exit if they want to. I think we've crafted something which is pretty good, to the point now where people are like, wait, this is too good. But yeah, that's the idea behind it all.
Awesome, man. Well, it looks, I think this is great. We've got 5K minimums. We've got, you guys have got 955K raised out of 2 million, 2.5. You're looking to raise by the end of May. So we've got about a little over a month left, and dividends start the following quarter. Yeah, I think this is great. I love the way you finance this. I love the way you're honest and open, and the way you do business. And as an Onfolio shareholder, I am not just rooting for you, but I'm hoping that the market will start to value Onfolio like they do other holdcos, because you're certainly following the same playbook. You're as well run, and it's only a matter of time until I think the market realizes that. So keep up the great work, Tom.
Yeah, appreciate it. Thanks for having me.
All right, man. We'll talk soon. Take care.
Bye.
See ya.